Welcome to This Week in Money. I'm Jim Goddard. Today, real estate consultant Brian Ripley looks at where your real estate might be on his plunge-o-meter. Mike Swanson from WallStreetWindow.com admits he's surprised by the continuing climb of the equity markets. We talk to Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to This Week in Money, Mike.
Oh, thanks for having me.
Taking a look at the markets right away. What caught your eye this week?
Well, actually, the market, frankly, took me by a little surprise this week. We came into August with a little bit of a drop following the July Fed meeting. The Dow hit its 150-day moving average, and things appeared weak. I thought we might see something of a correction. We've been so overdue for one. We haven't had a 10% drop or anything noteworthy in over almost 2 years now. So I thought maybe that could happen. And frankly, until it does happen, it's very difficult for me to justify buying into the U.S. stock market. But anyway, the market bottomed out and made new highs, at least the NASDAQ has this week, and everyone is excited. What's really surprising, though, is typically in a correction you see a bout of panic and some negative sentiment. We really didn't get that at all in the bottom. So I think it's real interesting.
That's what I'm finding, too. People, even if there's a big dip or something shoots up, they don't get excited. They went, well, yeah, it's a little blip in the market, but we're doing well. We have good fundamentals in what I'm investing in. I'm not worried. Are you like that?
I'm not worried about what I'm investing in, but I'm not really invested in what most people are, which are mutual funds and U.S. stock market funds and all that stuff. Even if the market has gone up, and I'm not saying we're going to immediately decline or something, but I'm invested more in commodity-related things, mining stocks, and things that I think are at a cheap valuation and poised to begin a new bull market, and not 5 years into one. I don't really like investing in markets that have gone up for 5 years and everything is at a very high valuation.
Well, Mike, I peg you as a good market rater. You told me Argentina, record low market, right. Get in. Cyprus, their market has never been lower. There's good priced commodities there. Get in there. Well, the prices are good.
Yeah, exactly.
Because, if they have survived through all these bad times, any company where, if the stocks hit a record low, they must be doing something right to survive. Well,
and that's the thing. If you are a value investor, which I guess I am when I look at the fundamentals for something, I look for really cheap valuations, and more often than not, to have that, you have a preceding bear market beforehand. And you can look all over the world. There's almost always a market like this somewhere every year where you can invest in it and you can see the start of a new bull market. Now, it's tough to always, predict the exact timing of something when a bull market will start. So we have the gold and mining stocks, for example, that, bottomed out over a year ago, and they're at very cheap valuations, They have peg ratios of a half, 0.5, a lot of them, when one is fully valued, and they're just going sideways, and the HUI's got resistance of 250, for over a year. So it's just a matter of time of when is it going to break out, but, until then we're sitting there chopping around. Conversely, though, if you look at the U.S. stock market, it's in the opposite situation. It's gone up for 5 years, so it's not in a position to start a new bull market. And then at the same time, if you look, at valuations, they're really quite crazy. One of the things I like to look at is the cyclically adjusted PE ratio created by Robert Shiller, and it takes the 10 years, a 10-year PE adjusted to inflation, average over 10 years adjusted to inflation, to calculate itself. In the U.S., and according to that, the stock market has the S&P 500 has a cyclically adjusted PE ratio of 26, which is the highest in the world. And the last time it got this high was back in 2007. So when you mentioned Argentina and Greece, theirs are below 4, to give a comparison of what a cheap market looks like. Now, a lot of people, if you watch CNBC, they say the market is fairly valued and it's not expensive, and this cap ratio doesn't mean anything. But if you look at other valuation metrics, you see the same thing. So if you look at the Dow, for example, the PEG ratio, which takes the earnings growth estimates for the next 5 years to make a PE ratio. So you're not just buying this year's earnings or next year's earnings. It's a way to look for cheap growth stocks or figure out the value that you're paying for earnings growth. Well, one is fairly valued. If you read the book, the classic book, One Up on Wall Street, by, what's the character's name who wrote that? Peter Lynch. That whole book says you need to invest in stocks with a PEG of 0.5, which are what the mining stocks are at. If you look at the career of John Templeton, that's essentially what he did. He looked for countries where there were a lot of stocks like that, would invest in them, and then after a couple of years, when they had a bull market and became highly valued, he'd sell and look for something else, which is essentially the strategy, I advocate people do when it comes to sectors and markets and whatnot. Well, the Dow has a PEG ratio over 2, meaning that if you go by the PEG ratio, it's twice the valuation of a normal valuation. Now, they justify that on CNBC or in the financial media by saying, well, interest rates are 0, so people need to pay up to buy these stocks. Well, interest rates were very low in the 40s and in the 50s, and stocks weren't this highly valued. And then what is going to happen the day interest rates go up? And it will eventually. So I just think it's a real mess. Now, that said, though, this month, these past couple weeks has been very interesting. I don't think we're necessarily in a bear market or the stock market's about to crash, and I'm not saying everyone needs to sell out of the Dow. Just because something's overvalued doesn't mean it can't go up more, but I wouldn't put new money to work there.
More with Mike Swanson next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're talking to Mike Swanson from WallStreetWindow.com. Mike, what do you believe will be the triggers for the next big correction in the market?
There's two things I'm looking at. I'm really watching things very closely to see if a new bear market starts, because I want to identify it to warn people, and I may bet against it and try to make money, but I really want to be able to warn people if that seems to be the case. And there's three things to look for. One is bullish sentiment. We have that. We had the Investors Intelligence Survey get to 62% bulls a few months ago, which is where it was in 2007, or right before the 87 stock market crash. We have massive margin debt levels seen similar to in 2007, also in 2000. And this week, the Association of Individual Investors, their survey showed a big jump in bullishness among the little guy in the stock market. So you have the bullish sentiment, but that's in itself not enough. The second thing is valuations, which I've already spoke about. The third thing, though, is sector deterioration. What that means is in a bull market, towards the end, fewer and fewer stocks and sectors participate and go up. And at the very end, you actually find many of them are actually already in bear markets. So in 2007, that fall at the top, over half the stocks or half the sectors in the stock market were below their 150-day moving averages, right at the high. And many of the Dow stocks and S&P 500 stocks in particular were in that case too. Now, what's been happening all year is there has been some weakening in the participation in the stock market among sectors and stocks. So if you look at the advanced decline line for the NASDAQ, for example, it's diverged from the market average. However, the situation is not as bad as it was at the top of 2007 and other bull market tops. So this is something I'm watching very carefully to signal that we're near the end of the bull market, but it's not at that point yet, and I'm not sure, if it's going to be this year in the fall it gets there or next year. It seems with this rally it could very well happen more likely next year. The reason why is this recent drop in August that was very short-lived. Those drops caused damage in the stock market structure in these sectors. So when the Dow hit the 150-day moving average and bounced, 2/3 of the Dow stocks actually fell below it and underperformed. Stocks like Walmart, Johnson & Johnson, and Home Depot really got hit very hard. And right now, one sector in particular that's in disintegration is the casino stocks. They have not bounced back at all. But we need to see this kind of thing happen more. So that correction, if it had been a deeper correction, it could very well have caused the type of deterioration that would be very alarming. Instead, it's just added to it. And if we get a bigger correction in the fall, then maybe, we'll be going into the end of the year really seeing this process occur in a more alarming manner. Now, the stock market has gone up about 4.5% since the low the other week, and it's not very realistic to expect it to continue to go up at a 4% rate week after week after week until the end of the year.
You're kidding, really?
It'd be kind of crazy. The market would be up 40% or 50% or something.
My house would be worth $1 million in 10 seconds.
Yeah. And then, but the problem, it would be wild. But so that suggests to me there's going to be some sort of dip or pullback at some point, probably in September, October, probably after the next Fed meeting. That's when this last one has occurred. So I kind of want to see what happens after that dip and then evaluate the market more and what's going on in these sectors. As far as actually making money, though, I'm much more interested in investing in the gold and in commodities markets and the mining stocks. Not simply because they're scared of the stock market, but because they needed the money. Economy's bad, some people got old and retired. Other people lost their jobs and still have not gotten one or not gotten one that provided them with the income that they had. Incomes have declined. It's just what it is. People have lost lots of wealth.
Mike, is there a website people can go to take a look at some of the things you're talking about?
Yeah, sure. My website's wallstreetwindow.com. It's all one word.
After the break, Brian Ripley on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is real estate analyst Brian Ripley, inventor of what he calls the plunge-o-meter. We'll talk about exactly what that is. Welcome to This Week in Money, Brian.
Hi, Jim.
Maybe tell us what the plunge-o-meter is and why we might want to use it.
Well, the plunge-o-meter is just a spreadsheet that I developed showing how real estate single-family dwellings in the big six Canadian cities of Vancouver, Calgary, Edmonton, Toronto, Ottawa, and Montreal, how they've fared since their peaks in prices, and that was several years ago, 4, 5, 6 years ago that I first started publishing it, and of course during the big correction, 2007 into 2009. The plunge-o-meter was pretty exciting to watch because we could see in real live time every month prices falling, and but since 2009, of course, we've had a wonderful rally in real estate, and prices have been rising, and most of the cities have put in a double top, and just only recently in the last 2 to 3 months have prices come off again, and there's a lot of red data bars showing up on the plunge-o-meter. So I think when we see the next correction happen, the plunge-o-meter will get a lot more popular in terms of taking a look at it and seeing how far these prices can correct.
Does that mean if you can sell your house right now, sell it?
I think that's really a decision that has to be made by every individual in terms of what value do they get out of the present real estate that they're in. And if their incomes are very secure, in fact, the security of your income, if it's as long as your amortization period on your house, then really there's probably no reason to sell. But if you're an investor with a negative yield on your real estate holdings, you may want to look at that, because a 10-year bond at 2.5% might very well be a much better yield-producing investment than real estate has been.
Now, taking a look at Canada, Vancouver, Calgary, Toronto, the 3 hottest real estate markets in the country, but are the prices being asked for reasonable right now?
I don't think they are reasonable. The exception is Calgary. Calgary is, of course, enjoying an oil boom, and one of the charts that I put together was a comparison over the last 10 years between the rise in prices of single-family dwellings compared to the rise in family income. And in Calgary, in the last 10 years, average single-family prices have increased by about 66%, but family income also rose by close to the same figure, 65%. So there's a rationale in Calgary for buying fundamentally overpriced real estate, because the people buying those properties have the family income to back it up. But in Vancouver and Toronto, it's a much uglier situation. In Vancouver, Vancouver single-family dwellings rose by almost 100% over the last 10 years, and yet family income only rose 33%. And in Toronto, it's just as bad. SFDs rose almost 80%, but incomes only rose 30%. So there's a real disconnect between the speculative fervor of the price of real estate and the actual boots on the ground income of what families are experiencing.
Have prices gone up because of foreign investment?
You know, that's a really tough question to answer because the real estate boards are not forthcoming about what passport holders are buying real estate, and of course the land registry system is not really open to the public unless you want to do a per unit search, so it's difficult to get that information. There is a lot of anecdotal evidence about buildings in the major centers where, you know, the lights don't go on in the evening, that kind of stuff, and taxi cab drivers have their tales about buildings that are 20, 30, 40% vacant during certain times of the year. So for sure there's been a lot of foreign investment. We know that globally foreign money has been searching the globe everywhere, and the big cities like London, Shanghai, New York, Berlin, Moscow, those centers have had huge bubble increases in the price of housing well beyond the fundamentals, and so the same thing has happened in Vancouver, Toronto, and Calgary, and in the smaller cities as well. But it's a speculative bet that capital gains in real estate will continue, and the people that are making these purchases don't seem to care about negative yield. So we'll see. That's been good for the last 10 years, especially in Vancouver, ever since Hong Kong was repatriated back to mainland China. But the next 10 years could be a much different story.
What about the real estate bubble in China, where they've built all these massive cities with nobody in them? Do you think the Chinese government can turn that around?
Well, I was just on the internet in the last hour or so looking at new charts that are coming out that demonstrate that most of the major big cities in China, their housing prices have actually turned the corner and have been falling quite dramatically. So I think there's some major changes going on, and we may see that overbuilding of Chinese real estate slow down quite a bit. So probably over the next year or so, it'll become quite a bit clearer that they can't keep that pace up, especially if they can't produce income out of all those units that they're building.
I know a lot of our discussion involves charts, and we should just let people know that if we start talking about a certain chart or a certain trend, you can see charts that back up this discussion at the website chpc.biz.
Thanks, Jim.
Yeah, just so people can take a look and find out you've been doing your research and we're not just making these numbers up. There's a big difference in employment rates across the country. Alberta, of course, going nuts with the oil patch, still demanding bodies beyond belief. What about the rest of the country, and how is that going to affect real estate prices?
Well, again, people buy real estate for two different reasons. One to live in, and that's something that people really do have to look at the fundamentals. They have to look at their income, their mortgage payments, the risk of maintenance and repairs, and rising rates if there are going to be any. And in different parts of the country, those stories are dramatically different. So if we take the poster child of high income in Canada, which is Alberta, the Alberta earnings are presently 23% above Canadian national average. They're about the same above Ontario. They're much higher than BC. They're 28% above BC. And Alberta earnings are also 34% above Quebec earnings. So you can see, there's a big divergence in the national picture, and local markets have different stories to tell. It also fuels immigration in Canada. We're seeing a lot of people moving from the provinces that don't have those high rates of income into Alberta. And just before we got on the phone, I did a quick search of Craigslist, and I discovered that if we look at Vancouver Craigslist listings for rent, just in one single day, yesterday, there were 1,600 units available for rent, and in Toronto there were 1,100, but in Calgary there were only 18 units for rent. Now, I then looked at the Calgary Craigslist units for sale, and that was also very minimal. There were only 638 for sale properties, but 25% of those units for sale advertised on Calgary were actually located in BC. So there's lots of people on Vancouver Island, the Okanagan, that are advertising their properties for sale in Alberta because they cannot get BC buyers to buy those properties because the prices don't make sense on a fundamental level. And so the pitch is, if the incomes are so good in Alberta and people are retiring out of Alberta, perhaps they'll pay a premium to live in BC. So again, if you're looking at housing from the point of view of ownership, it really depends on the locale that you're talking about. And then if you're talking about real estate as an investment, then it's very clear that investors are willing to give up a positive yield and exchange that for the idea that they're going to get a capital gain. And whether they get that or not is still a big question mark. They certainly have got it in the last 10 years, but again, are they going to get that in the next 10?
Will Vancouver's old thing, if you bought real estate at any point, if you just hold on to it for a while, say 10 years, even if you bought today, will it be worth more in 10 years? Will you have made a profit?
Well, we don't know, of course, because we don't know what a decade now is going to look like. So it's impossible to answer that question. But what you can do is look at your investment and look at your negative yield and try and make an analysis about how long you want to put up with negative yield before you see the capital gain that you want. And will the capital gain pay for that, plus all the costs of holding and reselling? So I've done a case study on a Vancouver condominium, and my analysis is that if Vancouver condominiums were to drop 25%, the prices of the condominiums, and I'm just talking about condominiums in the $300,000, $400,000 range, if you could get a 25% discount on the price, then you could compete with a 10-year bond and take a chance that your yield is going to pay for your holding. But as I say, people aren't getting the equivalent of a 10-year bond return. So investors are playing a very negative game at the moment.
More with real estate analyst Brian Ripley next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking to real estate analyst Brian Ripley. If real estate corrections really do begin, can you see panic selling happening? People willing to take a deep discount just to ensure a sale?
Yeah, you do see that in the market, and the blogosphere is full of individuals who are tracking price reductions. There's one very well-known one here in Vancouver, which I have links to on my site, and he or she tracks real estate listing price reductions, and they're running in the range of 25 to 30% from when they first got listed on the market. Sometimes 6 months ago, 1 year ago. Sometimes these listings have been relisted several times under different real estate agencies for the last 2 or 3 years, and they still have not sold because they've been too optimistic on their listing prices, and they've been chasing the price down and have been behind the market. So in terms of the asking price, there's been wild speculation on the vendor side of it. The sellers are just as hyped up as the buyers are in terms of what they think they can sell a product for. I just looked at a listing a few blocks from me that is similar to one that sold last year, and they've added an extra $100,000 onto what used to be a $400,000 product. They're now asking $500,000, and that's their speculative asking price just went up 20% in 1 year. Whether they get that or not, that's another question. So we can see that in the marketplace there's a lot of mispricing on both sides, both on the buy side and on the sell side.
When you say mispricing, people asking for too much and people expecting to pay too little?
There's two things going on. Sellers are extremely optimistic that they can sell a product, but when their inventory sits on the market for 4, 5, 6 months and they haven't sold it, they realize that they are overpriced, even though they believe that prices are going to continue to go up. And on the buy side, if a person wants to buy something and they have the money and can get the financing, and they also believe that prices are going to rise, then it doesn't really matter what they pay today, because their expectation is that tomorrow it'll be worth more. So it's a real juggling act in trying to sort out which listings really have better value. And again, that's a local story and really depends on the individual, whether he's a homeowner or just an investor.
Can people expect prices to start to plummet if interest rates go up?
Well, yeah, I think so. I mean, we've seen that before. Whenever there's a fear about rates, the first reaction is generally that there's a little pop in prices as people on the sidelines come into the market and bid the prices up. They want to get in before interest rates do increase. But if interest rates do go up substantially, holders of overpriced real estate and over-leveraged real estate also start getting nervous, and they might put their real estate on the market at a reduced price. So it's a continual seesaw of buyers and sellers, and the sentiment change really has to pick up speed and breadth before we get significant changes. So in the last major sell-off, 2007, 2008, going into what I call the pit of gloom of March 2009, not only did we get real estate as an asset sell-off, but we got a large stock market sell-off, and it was also global. So we had a huge buildup of a sentiment reversal that really picked up during that period of time. There was a lot of trouble. If we get the same sort of scenario where there's global sentiment change, that's going to affect Canadians' perception of what they think of their real estate. We as Canadians are up against this all the time because we see properties in the southern snowbird states that are 50% and less in terms of cost to go down there and buy acceptable real estate to live in. So we know that our property is overpriced, and we know that there's a possibility that it's going to change. We've seen the major corrections in the United States, in Japan, in Spain, in all sorts of markets. And we know that Canada is not that exceptional when compared to other exporting nations. We're a country of consumers. We consume much more than we export. We import more than we export. And the bell is going to ring at some time. And to answer your question about when we see that huge drop come, I'm not sure, because it's going to be dependent on a lot of other things that are going on in the world.
Well, people are expecting a major correction in the equity markets at any moment because they're at record highs right now. Mm-hmm. Is that something that will affect real estate?
Well, yeah, for sure, because in the investment community, people don't just buy real estate for their portfolio. They buy equities, they buy fixed income, they buy commodities. So they generally have a broad spectrum of investments, and if one part of your portfolio takes a hit and you need to raise money, you gotta try and sell the things that are most liquid, and we know that real estate is not that liquid. And if real estate has to be sold in a portfolio and it's not that liquid, the first thing that happens is that you get a big price drop, which is exactly what we saw in 2007, 8, and 9 when prices dropped dramatically.
If the price plunge happens, what kind of reductions in price can we expect to see?
Well, I think you're going to see at least 2% per month. So let's just take a look at the plunge-o-meter chart. I've got the history here. So from 2007 to 2008, Vancouver single-family dwellings dropped 16% in 8 months. In Calgary, they dropped 18% in 18 months. So there's a certain velocity that can happen in a very short period of time, and that's really all about sentiment. Again, it's not about fundamentals. People just change their mind, and they realize when prices are falling, there's no urgency to get in the market because tomorrow prices are going to be cheaper.
And that's really bad news for people who have for sale signs on their lawns right now.
Oh, definitely, because those people are already in the market to sell, and their neighbors are reducing the price, so they have to go with it.
Are people going to start taking their real estate off the market, or are they just going to hope that their price is right?
Well, again, the bloggers that do follow price reductions have noticed that over the last several years, there's been a lot of repricing both up and down, where a person will go through several repricings down, still can't sell their property, and then on the next repricing, they'll raise their price, thinking that it has some kind of magical idea that putting a price on that matches a much better property down the block is going to attract a new set of buyers. But over the long haul, buyers are much more educated than sellers are. Buyers go out and look at several properties before they commit. So buyer sentiment changes much faster than seller sentiment.
What about these real estate agents who've posted ads, I'll pay you $1,000 if we don't sell your house within the next 60 days? Are they going to be out of a lot of $1,000 checks?
I don't know about those in particular, but I would say that realtors who make those statements generally have a fallback position by saying, okay, here's the deal, I'll pay you the money, but this is where we think the value of your property is. And so if I can list and sell it in 30, 60, 90 days and meet that price, then I'm willing to give you that guarantee. But, realtors have access to all the market data, so they can make a much better bet than the rest of us who don't have as good access to the data.
One of the real estate analysts I talked to said the only two sure bets for real estate right now are Texas and Florida. Texas because fracking is bringing up new oil and gas, in Florida because the law there does not allow creditors to seize your property.
Yeah, well, I imagine if you talk to different people, you'll get different stories. I've seen reports on the internet about Florida as having water problems with flooding, and also there's been a bit of a bull rally in real estate in Florida since the big sell-off into 2009, but their prices are still very depressed when you compare them to other centers. So, one has to be careful when looking at each market because they're all different.
I heard from another person too, one of the reasons why real estate in Canada is expected to do reasonably well is that there really are only 7 major cities to live in this country, whereas in the U.S. you have a choice of dozens of different cities to live in.
Well, there's probably a bit of sense to that statement. Toronto is a sort of a good example for that. Even though Toronto has a big disconnect between the price of their real estate and the poor performance of their family income, Toronto is a huge market. So that if you look at, let's say, I'm just going to bring up this chart. If you look at their sales figures, their market is huge. They're 2 to 3 times any other city in Canada, and it's because they have the largest population, and so they can almost bank on a particular number of transactions happening in any given month. So sales right now in Toronto are in kind of 9,000 units per month, whereas in Calgary, even though Calgary has such great family earnings, they're only selling around 3,500 per month. And if you want to look at, let's say, Ottawa sells around 1,500 units per month. So size is important. Once you get a certain population base and a certain land mass, you see a lot of dynamic activity, but that still doesn't exempt it from big sudden sell-offs, because we've seen them in the past, and they can go on for quite some time, especially since Ontario is dependent on manufacturing and a lot of service industries, and also they get a lot of federal government subsidy to their corporate sector, probably more so than some other provinces.
Brian, is there a website again that people can go to take a look at some of these charts that you've referred to?
Yeah, if you just go to my homepage, www.chpc.biz, and you can go to my chart book, which shows all the listings of all the charts that I produce.
Thanks to our guests, Mike Swanson and Brian Ripley, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.